in what Adrien was presenting plays a huge role. The private market is going to be looking at that. And if it's looking, instead of three voices, which happened now, like in COVID, there were programs here, there were programs there. Okay, who's going to have? That doesn't seem to be a good way to proceed. That could be done now. And then, yes, of course, you need a better institution to put it all together. But I guess guys want to elaborate.
Yeah, maybe to complement what you said. So there is, and rephrasing what Ramon said there, if you look at the number, the share of debt that is held among EU institutions, broadly speaking, is already quite high. So the question on how, to embed this in the current proposal, I say we already have the main building blocks that are here. Of course, the fine-tuning of the details still need to be done, but it's if we really look at the numbers, we see how far we already are in this integration of the debt in the EU framework. I don't know if Luca wants also to say something.
You can take the mic, maybe.
No, again, not much to add to what you already said. I think once you have like a unified notion of all this program and all this debt which are around, then you also have a more clear way to enforce the fiscal rule because you have more transparency. That I think what also will bring all the things together.
Yes, please. Thank you. Nice presentation. Thank you very much. So the first question is, actually the focus is on the asset side of this fund, right? So what about maybe I missed something, but the liability side of the fund hasn't been discussed a lot. So in the current, especially in the current fiscal like framework of the European debt, how can you just develop a little bit the funding side of the asset side is clear of the fund. And the second question is related to the financial stability component of the fund. Can you develop further what is actually it's called the Financial Stability Fund? To what extent it contributes to the financial stability? Yeah.
Thanks very much. I like the new analysis, the fiscal rule, because the numbers make more sense than this big. No, the question I have is, of course, on the central bank. So I'm just wondering, like at the moment now, it's kind of passive, right? It's like it contributes because we say it should contribute. But then I was thinking when you were showing this optimal maturity and it was coming down, like normally shorter maturities is bad in some ways, but in terms of monetary policy pass-through, shorter rates are more effective, as in there, what you want the pricing of the economy to be is reflected quicker. So maybe that's a way to make this not worthwhile, but to consider the central bank's angle in this as well.
I have another. Yeah, thank you very much. My question relates a little bit to the first question. I was a bit flabbergasted, to be honest, because when I think about this fund idea, all I see is some sort of a off-balance sheet item that provides a new buffer that has to be funded by someone. And this is something like the EU borrowing activities or the ESM, or all the other vehicles that we have. So it's a new vehicle, and I think in order to do that, we need to come up with some sort of a argument. What is the added value? Does it just enable the European countries to go ever deeper into debt, just hide a little bit away the transparency with this new layer of a fund? What is the added value? If it does not generate, let's say, or coming from the other side, so we issue debt against collateral in the EU, the national budgets, the EU, other institutions, but the level of collateral, which is future tax income, natural resources, productive capacities, is limited. And if you just add another layer of funding vehicle having the same collateral limits, it kind of waters down the value of it. So I don't see the added value in a sense. And I would be happy if you could explain why this is not just financial engineering in a sense, but rather really adding structural value to the problem that we have already too much debt. And this vehicle gives you the opportunity to even increase the debt. Thank you very much.
Yeah, those are related. Maybe now I realize we miss a slide. The balance sheet is very simple. You have a contract, there was debt which was risky, and you transform it into an asset that is safe.
But
Now this asset that is safe, you can issue euro bonds, do whatever you want. You don't need a backup. You don't need putting money up front. You don't need any of that. Of course, at the end of the story, you have like the ECB. Yeah, they will be the countries at the end of the story, but you don't need them to put anything up front. So the value added is huge, because then we don't need to be talking about euro bonds of different colors and all kinds of things. Everything becomes safe.
you need to,
And that's a big difference. And I had not put any other layer. On the contrary, what I have done is the ones we already have, working more efficiently. That's it.
you need to fund somehow, right?
What?
You need to fund somehow.
No, I don't need. I don't need to put extra fund of anything.
No, you have.
I just need to buy the debt,
But how? So
get the debt, or be sure that the debt outside is going to be safe. And that's it. That's it.
Thank you.
Maybe
the other question.
On the central bank question, very good question. Yes, indeed, in our paper, central bank is more of a passive player. We are not having like the full-blown analysis where the central bank is the center of the picture. And I agree with you that there is this question of pass-through of monetary policy. This is not what we are analyzing. What I can answer you is that this is really an optimal maturity from the perspective of the fund. Then if you want to add an additional layer and to recalculate this optimal maturity, it's completely possible. Now you have seen that the optimal maturity is a nice thing to have, but in terms of absorption capacity, when you see exactly the numbers, it does something, but it's not the biggest part of I would say, the absorption. And you can reduce by 15 percentage points, but in the case of Italy, that would be my answer. In the end, it's not that big. Maybe I can add on, yeah, the funding source really, if I can refer to what Ramon was saying, this idea that in the end, we had already the experience with NGEU of common issuance, and why not taking this, this blueprint and trying to buy this debt, buy this common issuance, if I can say so. Yes, of course, the scale would be a different scale, but I mean, NGU was already a step up compared to what we were doing before. So I would say, why not again having one more stepping up on this? Yes. So on the financial stability part, so what we're really stabilizing is, we have a model where you have shock, you have a business cycle, and you stabilize it here. So if you're thinking about financial stability in terms of banking sector and stuff like this we are not explicitly modeling in the model. We have really productivity
Then
shocks.
probably you should change the name of the fund.
Probably, yes. That's the additional work that we have to do, maybe. Thank you very much.
For the Italian case with the optimal maturity of 2.9 years, I'm sure you've done a lot of empirical work on this. Was there a reason why you chose that the 10% buffer remaining is the optimal? Perhaps could you compare it with the buffers in domestic banks, and was there perhaps a maturity wall after the 2.9 years for the debt to GDP ratio to escalate dramatically above 90%?
Mm-hmm. I can answer this one. You want to answer? Okay, it's me. Yeah, again, so no banking sector. So it's obviously difficult through the lens of the model to exactly analyze your question. I would say you're right. A different buffer, given the consideration of the Italian banking sector, will be a very different analysis. Here we take, I would say, the view that we only have the fund, and from the perspective of the fund, that's what's optimal. But obviously, if you had additional layers of complication, the number that will come up will be different. But again, I would not stress that much this importance of the maturity, because you see that marginally it's not that important in the end.
Further question? Oh, okay, so I think it's a good time to close. A big thank you to our panelists and the discussant. I think it was a very interesting presentation touching upon the various aspects. So not only the overall design of the fund, but also the interplay with private markets, with the ECB, with fiscal rules. Thanks a lot also for the questions. I think lunch is waiting outside. It closes the conference.
Thank you also to you, Marianne, for moderating the panel. And this last social and moment together for a light lunch we served just outside the room. And thank you again for everyone, to all the speakers, to all the person and people that joined in our seminars, for the questions. And
Thanks. Well, yeah, that's the things.